operator and asset manager of the largest rental housing brand in East and Central Africa. So in the last 5 years, we have achieved market leadership in student accommodation sector through our popular brand, Kwetu Student Residences, which are spread all over the Nairobi landscape. I'm sure most of you will have interacted with the brand by now. So in 2018, we listed the first green bond in Africa. We listed that in the Nairobi Securities Exchange and also cross-listed in London Stock Exchange. This bond continues to earn many accolades to date. In 2021, and that's the subject of today's webinar, we issued the first student accommodation REITs in Kenya. So the Akon Development REIT and the Akon Income REIT. So I wish to warmly welcome you to this morning's session, which is kindly hosted by Njogu and Associates Advocates. I'll take probably 30 to 45 minutes to run you through a short presentation, which educates you on how to accumulate wealth via real estate investment trusts, and also covers most of the questions which we have received in the past. And then thereafter, I'll probably take another 15 minutes to address any questions the audience may have. So for the remainder of the time. So karibuni sana. So if you allow me, I'll probably share my presentation now. Thank you very much. Right, let me know if the presentation is visible to everybody. Muthoni, you can just confirm.
Yes, it is. Yes, it is.
Right, thank you. So we'll start from the basics. So what is a REIT? And REIT is an acronym for Real Estate Investment Trust. And so what is that? So I have two definitions which I use quite regularly. So the first one is that a REIT is a regulated entity that pools capital from many investors with the intention to acquire or invest in a diversified portfolio of real estate investment, which is under professional management. So REITs are not subject to corporate income taxes on distributed income, and a REIT distributes at least 80% of its ordinary taxable income to investors. So REITs cannot retain earnings, in simple terms. So another simpler definition is REITs are regulated collective investment scheme or investment vehicles, which then allow investors to pool funds for the sole purpose of acquisition of units or shares in a trust so that they can earn income from real estate without directly owning the property. So you have property ownership through a trust, and therefore the headache of putting up the property, getting occupancy, management of that property lies on the REIT manager and the property manager. So let's look at a basic structure of REITs. So if we go to the left side, let me just show that. So if we look at the left side where the investors are, and this is ourselves or yourselves, so investors buy or invest in REITs, which then buy real estate, and this real estate is managed by the REIT, and the real estate generates some rental income and also grows in value or capital gain. And then this income is distributed back to investors as dividends or distributed income. So the legal requirement is that at least 80% of profits or ordinary taxable income is distributed back to investors as dividends. So this is the simplest, sort of most basic structure. We can probably look at a more detailed structure. So it starts with unit holders or investors who then invest in the REITs. In our case, this is Akon Student Accommodation Income REIT. And therefore, the income REIT in turn takes ownership or invests in Kwetu purpose-built student accommodation or real estate. Then there is rent collected in Kwetu purpose-built student accommodation or real estate. This rent is payable to the REIT itself. Then in turn, the REIT makes distributions or pays dividends to unit holders. So this is quite a simple illustration of it. So it starts with investors at the top who then buy units or invest in the REIT. In the middle, you'll see that. And then the REIT takes ownership or buys a property. In our case, it's equal to student residences. That property is income generating because it hosts students who are tenants therein. And then once the rent is collected, it's paid into the REIT. And then in regular intervals, that happens twice a year rather, dividends are paid to unit holders. Then you have a trustee in that structure who acts on behalf of unit holders. And in our case, the trustee is Cooperative Bank. The trustees normally pay trustee fees to offer that service. On the left, you have a REIT manager. What a REIT manager does, in simplest terms, a REIT manager is also referred to as a fund manager. They offer management services to the fund or the REIT, and in turn, they earn management fees. You also have a property manager, very, very important, because we said the properties which are in REITs are under professional management, and for various reasons. And one is you need a property which is maintained by very high standards. So maintenance is a key thing to look at. You also need occupancy in those properties. So one of the biggest roles of the property manager is to ensure that occupancy is above target, so that, because then that is what informs rental collection, which is eventually paid as distributions to unit holders. So the property manager offers property management services and in turn earns property managers fees. An extended structure would also show a sponsor. So basically would an entity who's a significant shareholder who has invested in the REIT significantly. So in our case, this is Acorn Holdings Limited. So what are the types of REITs available in Kenya? So we have the three types of REITs. The first one is development REIT. So this one is where investors' funds are pooled together for purposes of development of real estate projects. So this REIT is very popular with institutional investors. And the reason for it is it gives institutional investors a punchy returns, but also institutional investors understand the risks that come with development. And institutional investors typically invest for long term. So if you look at pension funds, companies, they would be interested in investing here because then they get a return in the long term, which is above a risk-free return or rate. Okay, so then you also have a real estate investment trust that derives its revenues from rental properties. This is called the income REIT. So, and the income REIT primarily raises capital or raises funds from many investors and then invests that that money into rental properties, which are income generating. So investors gain through rental income and capital appreciation from the investments undertaken. The third REIT is an Islamic REIT, and that is basically a type of REIT that invests primarily in income producing Sharia compliant real estate. Right. So let's look at evolution of REITs. I get a lot of questions around, where did they start? Why is it that they sound so new? A lot of people do not know about them, even people in the industry. So REITs were first established in 1960 by the United States Congress. And the intention was to give all investors, especially the small ones, individual investors, access to income producing real estate. So for the first time, REITs brought the benefits of commercial real estate investment to regular Americans. Previously, as it has been in this market, that was a preserve of institutional investors or high net worth individuals. So from 1960, then Americans were able to, whatever small amount that you needed to save or invest, then put that in REITs. And the implication of this is that the real estate sector in the US grew, immensely during that period, between 1960 and 1980. Other countries followed suit. So Australia listed the first property trust in 1971. Canada waited up until 1993, while UK established REITs in 2007. So in Africa, the first country to establish REITs was Ghana, which did that in 1994. And therefore, that industry has since gained traction globally. And today, the REIT market capitalization stands slightly above $2.1 trillion. So since 2013, 7 countries, including Kenya, South Africa, Saudi Arabia, India, Vietnam, have establish property markets. And in Kenya here, we issued our first REIT regulation, rather capital markets issued our first REIT regulation in 2013, which then opened up opportunities for investors or real estate developers to get into that space. So let's look at regulation of REITs in Kenya. So who regulates REITs? So the Capital Markets Authority is a regulatory agency responsible for supervising, licensing, and monitoring activities of market intermediaries, including the NSE, the Nairobi Securities Exchange, the CDSC, and all other persons licensed under the Capital Markets Act of Kenya. So the Akon Student Accommodation REITs, the Akon Investment Management Limited, and VUCA are regulated by Capital Markets Authority. So the following are the primary laws used to regulate REITs. So and since I'm speaking to wakilis, you can look at it. So it's Capital Markets Real Estate Investment Trust, Collective Investment Trust Regulations of 2013, and the Capital Markets Authority Act Cap 485A. So these are the two laws which are primarily used to regulate REITs. So which REITs are registered in Kenya? So there's 3 REITs registered in Kenya, which are also trading in the Nairobi Securities Exchange, and these are Ilam Fahari REIT. This was the first REIT which was issued in Kenya. It's an income REIT, and then followed by the Akon REITs, and this is Akon Development REIT and Akon Income REITs. These were issued in February of 2021. So as you move along, you'll keep hearing about USP, or the unquoted securities platform. So for those who've been investing for a while, you know there's main board where quoted companies or listed companies trade their shares or stocks. So, and for instance, if you wanted Safaricom shares or EABL shares, you'll find them listed in the main board, okay? The unquoted securities platform is an automated solution by Nairobi Securities Exchange used for issuance and trading of securities of unquoted companies. So the platform enables companies to access capital markets for long-term funding through private placements and restricted offers. So the Akon Student Accommodation Development REIT and Akon Student Accommodation Income REITs are traded in the unquoted securities platform at NSE. So what are the benefits of USP, or the unquoted securities platform? So it's a convenient route to transfer unquoted securities, very, very important, because it offers efficient entry and exit for investors, thereby increasing liquidity. So when you speak to any investor, one of the things they look at, even if they're looking to invest for long term, or whether they are looking at a long term horizon, is should I experience shocks or bumps along the way? How liquid is my investment? And we'll probably discuss a bit more about it. And one of the reasons people have been shy in the past, as much as real estate is very popular with Kenyans, is they want to know, how quickly can I liquidate my investment? We all know that if you have a plot of land somewhere out in the outskirts of Nairobi, you probably spend 500,000 shillings on it, and you had an emergency, or you wanted to get into a different type of investment. Liquidating that piece of land would take you anywhere between 6 months, 1 year, if you're lucky. So it's not a very liquid investment. But if you look at REITs, the sole reason why they're very liquid is because they're tradable instruments, meaning that should you want to exit your position, you just sell your REITs at the NSE USP, and then you get your cash. So that's very important. The other reason is that there's increased transparency for investors, because once you trade anything at NSE or you list anything at NSE, there's a lot of information which is shared publicly, and that gives confidence to investors. So the other one is also around settlement delays. So it avoids settlement delays if the funds are held by the custodian bank, who ensure that the funds are available within the period that the investors are sort of advised when they're supposed to get their money. And the other one is it allows surveillance by the exchange and regulator, and therefore reporting by players, media, and everybody is easy. So this is not like a typical private real estate project. This is, if you look at the information around the net asset value, the unit price, and so on and so forth, are publicly available, because this is information which is required before you can trade the REITs at NSE. So the other one is the register of investor is maintained by an independent registrar, in this case, the CDSC, and thereby there's no chance of manipulation. So for those people who've invested directly in real estate, once you get into a project, for instance, you're doing an off-plan project, and you put in some money with an investor, which is now a direct investment. That register is maintained by that particular investor, okay? But in this case, there's an independent registrar who maintains the register for all investors, and thereby sort of providing a governance process to ensuring that there's no chance that an investor will either drop off, or an investor has no idea of how many shares or units they own. So that process is transparent. So who are the CMA licensed REIT managers? Again, this question comes up because people want to know who is the fund manager of Econ REITs, and what other fund managers are allowed to manage REITs. So I've just listed a few who are licensed REIT managers, and Econ Investment Management is one of those. And these REIT managers are licensed by Capital Markets Authority, as I mentioned earlier. Right, so let's go straight to the benefit of REITs. And when I talk about REITs, I like tying the story of the reason why we save and why we invest. Primarily, and we had this conversation with Muthoni as we started, is before you can even talk about wealth preservation, before you can talk about returns and all these other things, you have to accumulate wealth. Okay, and the way you accumulate wealth is by, first of all, investing in a portfolio of investments that, first of all, you're familiar with, that makes sense, and which give you some capital gain, but also consistent returns over medium, long term. And how you also accumulate wealth is by ensuring that you get into investments that over long term will cover you against the inflation. So let me get into the benefits of REITs. The first one is obviously consistent income. If you look at Econ REITs, they give 11.1% rate of return over a 10-year investment horizon. That return is a combined return. So you have 7.1% as dividend payout, and 4% as capital gain. So meaning that over a period of time, once you've been invested, you will get your consistent income, because the dividends are paid twice a year, and there's also a requirement by law that at least 80% of income, ordinary taxable income that come into the REIT, is paid in form of dividends. So that is one. Two, the capital gain ensures, one, you sort of are protected from inflation, but also you get, as you move along in your journey, the value of your investment is growing. So I get a lot of these questions when people are especially talking about diversification of portfolio management. So if you look at your typical portfolio, for a person, say, who's invested in stocks, you've invested in, say, bonds, government bonds, and then you've invested in land, actual land, and probably REITs. If you look at those four asset classes, they all have different behaviors, okay? And having a REIT in there is important for the simple reason that if you look at, for instance, bonds will give you a return, a punchy return, but there's no capital gain. So if you put whatever amount of money that you've invested at the beginning, that's what you expect to get out at the end, apart from the coupon which is paid out. If you look at stocks, stocks are also an excellent investment option, but so stocks will gain in capital if all factors are working out for that company. But the other thing you need to think about stocks is that they pay dividends. They may pay dividends if the company makes profits. The company may also make profits and they may not pay dividends. So there's no requirement that stocks will pay dividends. In REITs, it's a requirement of the law that at least 80% of ordinary taxable income has to be paid out as dividends, and therefore REITs do not retain earnings. So this is a huge benefit, especially for people who are looking for for some cash flows. I'm looking at people who are probably in retirement, or companies that are looking to get consistent cash flows out of their investment as they remain invested. So the other one, which is very important, is the diversification, and I mentioned this. When we teach investments, we teach a couple of things. One is consistency, the fact that you have to be in the game for you to get some. First of all, you have to be in the game, and the second thing is you have to be consistent. You have to consistently invest for you to accumulate wealth, and obviously you cannot put all your eggs in one basket. So REITs offer an excellent diversification route, especially for people who are already investing in fixed income, equities, and all these have different long-term investment characteristics. Thereby, having a REIT in your investment portfolio creates diversification when that is combined within a single portfolio. Transparency, investors are able to understand exactly what they're invested in terms of actual costs, actual assets, and returns. Now, the beauty of REITs is when money is invested in a REIT, the law requires that that money has to be invested in an income generating property in under 2 years. At Aecon, we do that, we do that almost instantaneously or in a shorter period of time because we have a development REIT. And the development REIT develops. By the time this property is getting into the income REIT, it already is fully developed and is fully occupied, and it has been stabilized for a period of time. So the transparency aspect comes because you can actually see and touch the buildings, and therefore you know what you exactly own in terms of your investment. So capital appreciation, I mentioned this a short while back, and why that is important. So when a REIT holds real estate that is high in demand, like our Kwetu student residences, the regular rent escalations and also the growth in value of a building ensures that the investors' units will grow as value and rents appreciate over time. So that is very important. Why is capital appreciation important? One is because we all want to grow our wealth. Two, when you're investing, you also want to keep an eye on inflation so that as you get returns or as you grow your investments, then you ensure that you're not losing out because of inflation. So that capital appreciation is very, very important. Capital protection, REITs, and I dare say REITs are the only investments which are backed by actual income generating properties, which then offer a regular return to the investor. So that gives comfort to the client in terms of capital appreciation, but also ensuring that because you're invested in real estate, there's land, the property on it, which is income generating, your capital is protected. There's no chance that fluctuations or whatever it is are going to impact your investment. So that is very, very important. And that's one of the benefits that a lot of people who have gotten into REITs cite as a reason for getting into REITs. And another very, very important benefit is tax exemption. I mentioned that REITs are exempt from corporate taxes, capital gain tax, stamp duty. So that allows more income to be available for distribution. It's also important to note at this point that unlike many other investments, that the distributable income, which is the dividend bit of your return, is only charged 5% withholding tax, as compared to 15% for many other investments like money market funds. Liquidity, I mentioned when we started that one of the things that investors are looking out for or think about, or one of the things that keeps a lot of investors awake at night is if quickly can I get that money? It's allow an investor, one, to buy units rather than an entire asset. So you don't need to buy an entire building. And so that makes it easy for you to get in. But most importantly, because the REITs are tradable, they're tradable on the Nairobi Securities Exchange USP, means that you can easily gain entry and exit, and that gives liquidity, makes the REIT extremely liquid. From a point of view of, if I look at the experience so far in the last 1 year for REITs, I'd say 98% of the orders received on USP are buy orders, and just about 2% have been sell orders, meaning that REIT is extremely liquid. So getting out of it, should you require that, is easy. So professional management, this is one of very underrated benefits. When we think about real estate generally, if for those of us who own any rental units, it takes time, first of all, and money for you to buy land. And then it takes time, a lot of capital, and a lot of skill for you to then put up the property. And once you have the property in whatever place you have to think about occupancy, because that's the only way to get a return out of that property, especially if it's rental property. Then getting occupancy, once you get occupancy, then how do you collect rent? How regularly do you collect rent? How do you manage the tenants who are in that building? Okay, how do you maintain the properties? What standards are you using? So professional management is very important. So access to a professional team of investment management, property management, development management, to handle the acquisition, development, and the day-to-day management of that property is a key benefit, which you would not ordinarily access if you're running your own properties, apart from the fact that it's a headache and it takes quite a bit of time and money to manage. So let's look at, when you talk about benefits, I also like to talk about the risks. And what are the risks of REITs? When you look at risks, you have to separate the risks which touch on the various REITs. So we have two REITs. If you look at development REITs, and I defined what those ones are, they're primarily they primarily pull money from investors or funds from investors and invest in development of properties. So if you look at that, you have to think about what are risks involved in development, okay? And then if you look at income REITs, by the time a property is in income REITs, it has already been developed, it has already been stabilized, meaning that there's tenants in those properties, and you've hit at least a certain threshold. In our case, usually 80% of occupancy before you take them to income REITs. So what then are the risks that you look at when you're looking at income REITs? So the first one is occupancy. The properties are dependent on occupancy to get profitability. Therefore, a decrease in occupancy will have an impact on investor returns. Now, on this first one, when I talk about risks, I also like to talk about how do we mitigate that. So when you talk about occupancy, it's a factor of a couple of things. One is it's a factor of a specific asset class that you get into, and I'll mention those asset classes. You can decide to get into, for instance, commercial property that is retail in nature, so like malls, okay? So if you think about malls and you think about who occupies malls, you have to think about where you get these people to occupy those malls. You can also get into properties which are residential in nature. That's another asset class. And now, if you think about residential properties, those have a different behavior from, for instance, now in our case, student accommodation. So, and why is student accommodation lucrative? One is, and I'll talk about this opportunity later on. There's a huge demand for student accommodation in Kenya. Just about 500,000 kids turn 18 every year. You can look at the results, at KCSE registration. And what that tells you is, of these 500,000 kids, just about 400,000 of them come to Nairobi and areas surrounding it to either go to tertiary colleges or do a university degree. The other thing that you need to think about when you think about that asset class, the student accommodation, is for years, what has happened is that a degree has become a baseline, sort of a certification or a qualification for you to get, a form of jobs. Most people have opted to get degrees, and that means that a lot of people eventually end up doing degrees, and if they come to pursue their university education and tertiary education in Nairobi, they will require a place to stay. So if you look at the level of, the number of beds available for student accommodation in Nairobi across universities, that number is just about 40,000, meaning that they're addressing only 10% of the demand. So 90% of these people are either staying home with their parents, for those people who live in Nairobi, or they're staying in outbound areas, Nairobi West, Githurai, the whole of Thika Road, outskirts, places that, are neighboring universities. If you're thinking about KU and JKUAT, you also have people staying, in the Kahawa area. And the bulk of those are improvised. It's not proper student accommodation. You do not have the communities, the facilities, the amenities that will provide you with a good learning environment. So there's a huge demand. And how we've addressed that is by ensuring, one, we got into an asset class which is in high demand and up until now has very little competition because we are the market leaders. If you got into, say, for instance, commercial properties, you know what happened after COVID, okay? Offices were giving up entire floors. And also when you're negotiating rent, you're negotiating with a corporate entity, meaning that there's going to be revenue compression. And also when you talk about occupancy in commercial properties, when one company leaves the property, you lose occupancy to the level of which that company had occupied your building. So it's not easy to continue to drive occupancy, especially if you're running commercial. If you look at student accommodation, our typical building has just about 1,000 beds. So assuming 100 students left the property, you still have 900, meaning that you have 90% occupancy. So this gives us a very good control of how we get the properties occupied. The second one is obviously where we have placed these properties. For those of you who frequent Hurlingham areas, you'll see where one of our newest properties is, the Kwetu Hurlingham, which serves Daystar and universities around there. It's right next to Daystar. For those people who've seen our property next to Strathmore, it's called Wilson View. It's right next to Wilson. The whole purpose of this is to ensure that the students are not traveling far from the university, and they can engage, form communities, and also read or learn from their hostels. So very, very important. That's how we are addressing that as a risk. And this risk is specific to income REITs. Right, for development REITs, the risks we look at is normal risks that are involved with development. So project delays. If a project is delayed, it means that there's, the site cannot be developed in good time. There's delay in its stabilization, among others. So, but that is not applicable to income REITs. I mentioned that is specific for development REITs. And these are risks which institutional investors, the ones who predominantly invest in development REITs, are aware of. The next risk cuts across it. I'm sure it touches even on what you do professionally. It touches on retail business. It touches on banking, insurance. It's economic and political instability. So if you look at what is happening, for instance, right now, because of elections, instability can lead to closure of properties, sites, decrease of properties, and also diminished effective demand. So that would impact any business. A limited pool of investors, especially this is in development REIT, because of the nature of development, are targeted mostly to institutional investors, and those are few. There's only a defined number of pension funds. There's only a defined number of companies. So and development REIT is limited to institutional investors who are fewer compared to retail investors. So there's usually a concentration risk. Right. Let's look at our REIT advisors. Who else is involved? And the importance of this is obviously when you looked at the REIT structure, you'll see there's also regulation around it, ensuring that apart from the structure, the structure that the REIT sponsors puts in place, there's a structure the regulator requires. And that structure has to have a trustee. You have to have independent auditors. And these are not auditors that you're using as a sponsor or in one of your companies. You have to have independent valuers. And if you have to have REITs, like two REITs in our case, you have to have separate valuers. So I'll mention that the trustee of both REITs, our Acorn Student Accommodation Development REIT and the Acorn Student Accommodation Income REITs, is Cooperative Bank. The legal advisors on the development REIT is AAA OK Law Advocates, and on the income REIT is Gowling WLG. The auditor and reporting accountant on the development REIT side is PwC or PricewaterhouseCoopers. On the income REIT side is Deloitte, and that has to be kept separate. And because these are two separate entities, the valuer for the development REIT is Tyson's, while the valuer for income REIT is Knight Frank. The registrar, like I mentioned earlier on, is CDSC registrars, and that ensures transparency in terms of investor register, and also when you talk about settlement, when you're disposing of your REIT and you need your liquidity back, it goes through CDSC. Right. Let's talk about operational properties in the REITs. So in the income REIT, we launched the Acorn Student Accommodation Income REIT with 3 properties, and that was Kwetu Wilson View. This is the property right next to Strathmore. There's Kwetu Ruaraka. This is at the beginning of Outer Ring Road, and Kwetu Jogoo Road. We have since added Kwetu Parklands into it. And for REITs, the reason why people are usually advised to come in early is because as you keep adding properties into the REIT, then the value, the net asset value grows, the unit price grows, there is capital gain in terms of whatever has been invested, and also a bigger addressable rental base to pay dividends. So there's a plan to continue adding properties. I think we'll be adding Aberdare Heights before the end of the year or early next year, to make the number to be 5 properties in the income REIT. So in the development REIT, the properties which are under development REIT are properties either which are under development or which have been newly developed and are under stabilization. I mentioned what stabilization is. Stabilization means that you have to get occupancy, meaning that you have to get students to occupy these buildings, and at least touch an occupancy of 80% or at least 6 months to 1 year before you can get it into the income REIT. The importance of that is so that by the time a property is getting into income REIT, it's already generating rent optimum. You have at least 80% of your occupancy. You're breaking even in the building. You're covering your base costs. So by the time you're getting into the income REIT, you're literally just turning the ownership into investors who then start earning from that rent, earning dividends from that rent. Right, so in the development REIT, properties which are complete is Kwetu Aberdare Heights. This is the first property at USIU. On the right side, if you're coming from Thika Road. And then opposite it, we have Kwetu USIU as well. So we have 2 properties in the USIU area. And then Kwetu Hurlingham. This is our newest property in Hurlingham. It's opposite GOD, right next to Total. It was, I think, yeah, right next to Total petrol station, and very close to Daystar University. There's other projects under development in the development REIT. We have Kwetu Chiromo. For those of you who've driven, along Riverside Drive, just as you approach the flyover that connects the Dusit side with the Nairobi University side, at that corner you'll see a development, a huge development which is coming up there. So we are doing Kwetu Chiromo, which will serve the University of Nairobi, and also Kijani Chiromo. So these two properties will have an occupancy of at least 2,000 beds, and they will be primarily serving Nairobi University. Then we have Kwetu Catholic University, or Kwetu Catholic Where. These are projects which are approaching the tail end of development, and Kijani Where. So I'll mention the difference between these two brands. So Kwetu is our premium brand, which a lot of people know. Kijani is a new brand that we're putting in place. It's going to be more affordable. It's targeting affordable housing initiatives to give a bigger reach to students who may not be able to afford our premium brand. So the Kwetu Catholic is going to be opened towards end of this month and to be ready for the September semester. And the Kijani Where will be ready 2 months later, hopefully by October of this year. Right. I like making comparisons of REITs and money market funds because REITs were primarily modeled after mutual funds. So they have a lot of similarities, but also some differences. And when you look about mutual funds, a lot of Kenyans are familiar with money market funds. And the reason for that is they've been in place for at least 20 years. Most people have experienced them. They have invested their money there. And money market funds offer an excellent place for investors to place funds over a shorter period of time, or when you're investing for what we call short-term period. This is up to 1 year, okay? So the similarities are as follows. So both are regulated by Capital Markets Authority. Both involve pooling of funds. So even in money market funds, the promoters normally pool funds from many investors, then invest in government paper, for instance, or government securities. In the case of REITs, there's pooling of funds, but which are invested in real estate. Both involve visible or existing assets. In the case of REITs, these are actual buildings which are income generating. In the case of money market funds, these are government securities. Both involve income generating assets because, again, real estate which is income generating collects rent from tenants. And for money market funds, which invest in, for instance, in government securities, there's coupon paid regularly, and therefore the promoters are able to pay interest every so often. So both are managed by a fund manager. In the case of a REIT, the fund manager is referred to as a REIT manager. And I mentioned the REIT manager has to be licensed and regulated by Capital Markets Authority. Both are structured, and this is to protect the investor's interest. So they have a trustee, a custodian, and a fund or a REIT manager for compliance. And all of these players in that ecosystem are regulated by Capital Markets Authority. Both are transparent, so you exactly know what someone is investing in to a large extent. In the case of REITs, it's outright. The REITs only invest in properties which are income generating. In our case, it invests in Kwetu student residences. So what are the differences? So REITs invest in real estates with rental income. I mentioned that. REITs are required by law to distribute at least 80% of their income to their clients or investors. In REITs, the unit price grows due to capital gain. So for money markets, you're investing in government securities, which do not, gain in terms of capital. So REITs are listed or traded in the Nairobi Securities Exchange USP, and so this makes them extremely liquid. And not to say that money market funds are not liquid, but I know withdrawing from money market funds has implications. REITs are medium to long-term investments. Money market funds are short-term investments. So if you're looking to park money for, say, under 1 year, and you want to access that money quickly, it's always advisable that you put them in money market funds, because then you're earning a punchier return than you would earn in your savings account. But if you're looking to invest in the medium to long term, because of capital gain, REITs are an excellent place to look at. So let's look at 2021 performance. I mentioned that we rolled out our REITs in February 2021. And in that period, by the time we closed the year, this was the performance. So I'd like us to quickly go through it, because I get a lot of questions from this. The operating revenue from the income revenue was 342 million. The total profit was 350 million. The net asset value of the 3 properties which are there, so the REIT is 3.5 billion. So that will go up once we've added, now that we've added the 4th property. The NAV per unit, or the unit price, we rolled out the REITs when there were 20 shillings. That grew to 20.8. So this is a 4% capital gain. The full year distribution per unit was 1 shilling and 0.02 cents. So if you look at the dividend yield from that, that is just about 5.4%. The capital gain I mentioned is 4%. So the total return was 9.4%. In the development REITs typically do not pay any dividends in the first 3 years. And the reason is they raise capital, you buy land, you break ground. A project takes roughly 3 years before you sell. So, and that's why they're targeted at institutional investors, because these institutional investors understand that, and they're also patient to invest in the long run. So the operating income was 1.1 billion from the development REIT. The profit was 750 million. And the net asset value was 5.2 billion. The properties which are in the development REIT. And therefore the NAV per unit, or the unit price, grew from 20 shillings to 23.84. So what's our story and how can you be part of it? I mentioned about I like painting a bigger picture so that people understand why there's opportunity and why then you should get into this investment. So I mentioned there's more than 400,000 university and college students in Nairobi, and there's only 10% accommodation for those in campus. So for those of us who live near campuses know that a lot of students live in makeshift, or what is not really purpose-built as student accommodation around these universities, therefore exposing them to a lot of vagaries. So a lot of parents are not comfortable with that, and students have to either travel long distances or encounter a lot of obstructions on their way to campus. So we saw this market gap, and the market gap is obviously 90% are not occupied on campus, and there's demand for student accommodation. So Acorn then in 2017 opened the first student purpose-built accommodation unit on which is Kwetu Jogoo Road. So since then, by 2020, we've done five other Kwetu student residences over that 3-year period, maintaining an average occupancy of 90%. This again is a testament to the demand of the properties, but also of that asset class, the purpose-built student accommodation. Someone asked me, so why didn't you guys get into residential properties, for instance, in Kileleshwa and so on and so forth? So this explains why it was prudent for us to get into this asset class. So in 2021, we issued the Acorn Development REIT and the Acorn Income REIT, and I mentioned that. So, and it was the first pure development REIT issued globally. It's the first one, and the first student accommodation REITs in Africa, and the first issuance is to list on the USP at Nairobi Securities Exchange. So it has very many firsts. So looking forward, so by 2023, the plan is to have built 2 other purpose-built accommodation housing brands. So Kejani, I mentioned this is our affordable student residences brand. And Palma is going to be targeting young professionals, the ones who've just come out of uni, and they want the same experience they've gotten at Kwetu, and you do not want to go live in places so far outside of town. We'll have a property coming up right opposite KBC in town. And that will be targeting young professionals. So we have an entire plan looking at the life stages of young people up until where they're ready to have families. We'll still develop starter homes for them. But up until 2030, our target is to have provided at least 40,000 new purpose-built student housing beds across our 3 brands. So the Kwetu student residences, Kijani, and Palma. And that's where we're inviting people to be part of this story. So over years, we've achieved market leadership in student accommodation sector through our brand, Kwetu Student Residences. So by 2030, we're expecting to add 3 times to our existing bed capacity to just touch 10% of a demand for affordable and quality student accommodation in Nairobi. So we are at the start of this growth journey. One of the reasons why corporations or companies go to the capital markets is to align the demand in the market with the growth required to meet that demand. And that's what we are doing currently. Okay. So just a few numbers that I like throwing to people when I'm speaking to in forums like this. Did you know that there's just about 1 trillion tied in capital in land in Nairobi. So 1 trillion in capital is tied in land in Nairobi. Then up to 12 trillion shillings. Okay, if you think about 12 trillion shillings, it's just about how many expressways, because an expressway costs this expressway costs just about 50 billion. So if you think about this, this is just about what? It's more than 20 expressways. Okay, 12 trillion is in capital is tied up in land in Nairobi, Kajiado, Machakos, and Kiambu. And there's reason for that. We grow knowing that the most reliable sort of investment, the easiest to get into, the one that did not have a lot of barriers, is real estate. So everyone, as we started our careers, as people got married, as people started families, the first thing they think about is, I need to get a piece of land. I need to get a plot somewhere. So we are very emotionally connected to real estate. We all want to benefit from it. So if you're not living in it, it means it's a business or it's real estate. It has to be profit making. So that option is rarely available to individuals because it takes time, it takes money, a lot of money. It takes effort for you to be able to generate occupancy and then get rent and generate profit. So it's a lot of work. You also can't do it in small chunks. You cannot build one room out of a 3-bedroom house and then rent it out. You have to do it wholesomely, complete before you get a tenant on board. You have to have windows, doors, and so on and so forth. So that is not easy for everyone. So the Kenyan regulatory environment now enables investors to earn from income generating properties through real estate investment trust, the REITs. So this framework allows income generating assets to be professionally managed under a regulated framework. This opportunity was previously only available to institutional investors, but is now open to retail investors like you and myself. So let's look at the solution. I mentioned VUCA initially, I did not define it. So what is VUCA? So VUCA is an exclusive invite-only investment club that allows investors like Jennifer, Lucy, Mark, and you to own units of a constituent resident accommodation REITs. So through our digital platform, VUCA connects individual investors to owning units or shares of profitable real estate affordably and conveniently. So in other words, VUCA ni chama ya real estate. Before I look at the benefits of VUCA, I'd like to give a bit of a background on why we have VUCA. So if you look at the REIT regulations, they have certain minimums for you to invest in REITs, and that is 5 million shillings for you to invest in REITs directly through a broker, meaning that the bulk of the retail market or individual markets will be left out. Okay, it will still be a preserve of the HNI, anyone who's able to raise 5 million shillings, or institutions, which is the reverse of what the government and companies have been trying to do, meaning that we need to avail more opportunities to retail investors to get a piece of a pie, like Muthoni defined it, a piece of real estate affordably and conveniently. So these regulations presented an opportunity for us. So if you look at the fact that you require 5 million shillings to go directly to your stockbroker for you to be able to buy from the stock exchange, then VUCA was born out of it. So VUCA is a Kenyan-born innovation, which aggregates demand from many individual investors. So by the time it's getting to USP, it has hit the threshold of 5 million. So that's all that VUCA does. And VUCA has been styled as an investment club because Kenyans understand chamas, they're familiar with chamas, and there's regulations now to govern regulated investment clubs. So what do investors expect when they buy REITs through VUCA? So obviously they expect a product which is regulated because VUCA is regulated to start with, and the REITs are regulated at second level by Capital Markets Authority. So in terms of tenure, it's a favorable terms under which assets are held. So allowing investors to buy units for wealth accumulation in the medium and long term. So even if you're looking to accumulate wealth for 10, 15 years, you can buy, you can buy what you can afford, in small bits and sizes and accumulate wealth over long term. So the quality of assets I mentioned, these are actual assets. These are buildings sitting on a piece of land. And I'm sure a lot of you have seen that brand scattered all over the Nairobi landscape. So the quality of assets means that it's an actual building which you can value, which has people in it, and therefore rent is being collected. And I mentioned why that asset class is attractive. So it helps you to get committed to your savings goals. I have interacted a lot with investors the last 1 year. And one of the biggest frustrations people have is you're earning a very significant amount of income, but with time you're not able to show in terms of what you've invested, you also are not able to show savings. And why is that the case? Because saving and investment is also a habit. You have to develop it. And you need something to get you committed to that journey. And therefore, VUCA, because of how it's built and styled, helps you to get committed to that journey. And the reason is it's a self-service portal. It's a self-service portal which allows you to go in it and invest either through an M-Pesa or whatever it is. Every time you want to invest, you do not have large minimums. You can invest as little as 200 shillings and as much as 5 million shillings in the REIT if you want to. And therefore, you are able to discipline yourself or create a habit and get committed to that habit by saving consistently towards your goals through VUCA. So that's very important. The other one is flexibility. And flexibility, there are two ways of looking at it. One is how efficient, how easy it is for you to buy little bits and units of real estate, at any one time, but also flexibility around how quickly you can liquidate your investment. Should you hit, should you hit an emergency or a time of need and you want to withdraw your savings? So it's quite flexible. And the reason for that is because they trade on Nairobi Securities Exchange, USP. So it's very easy to exit. It's tech-enabled, user-friendly platform that allows you to buy and sell and monitor your investment. So once you get onboarded, you have your own account and which you can log into every month or every evening, as often as you'd like to. You can view your investments and you're able to either buy more REITs or sell the REITs as you move along. So that crossing over is a big milestone for anybody who wants to earn, who earns and wants to save a bit of their earnings for a better future. We'll all agree that savings is not easy. Creating a savings culture in the midst of consumerism, when we're bombarded with all these things on social media, when we have bigger friends networks, when we are all educated and exposed, we are all urbanized. It's not something easy because there's always competing priorities. But when speaking to forums like this, I like posing questions. But just when you look at your goals, okay, and you look at your 1 year goals, okay, let's start with 3 months, 6 months, 1 year goals, and then you compare that with your medium term to long term goals, 5 to 10 years. You'll find the bulk of your goals in life are medium term to long term, and you can try that as an experiment. You will not have a long term goal to change your phone, okay? That might be a short term goal. You want to change your phone, get a new fancier phone in the next few months or 1 year, okay? However, your children's education is a long term goal because you might not have started having children, or if you have children, they're still growing and they've not gotten to that age where you require that significant chunk of money to take them, for instance, to high school. Retirement is a long term goal. Wealth accumulation is a long term goal, okay? It's not something short term. The bulk of your goals will be medium to long term. So we have to also plan with that in mind so that our investment horizons are aligned to the the term of our goals, and that's very, very important. So what makes VUCA stand out? I like comparing VUCA with other investment products, and I like to score it on affordability, convenience, tax incentives, the stability of income, and then quality of assets. To be honest, if you look at VUCA rental units, plots of lands, NSC stocks, insurance, investment products, life products, and non-life products, conventional money market funds, a lot of you are in this. All of them have quality of assets, okay? All of them are good quality assets. They're all regulated, save for rental units and plots of land, which you have to go out, buy that piece of land by yourself and then build. However, when you look at affordability, you cannot say that rental units are affordable. You have to first of all buy the piece of land, which is also not affordable, and also the process of buying it. If you look at our land tenure systems and everything, there's challenges around buying and owning land. It's not a straightforward thing. NSC equities, they're affordable because you can buy small amounts of shares. Insurance investment products, also affordable. Money markets, you can put in as little as 1,000 shillings or so on and so forth, depending on the scheme. For VUCA, it's affordable because you can buy as little as 10 units. So if you look at the prevailing unit price right now at 20.8, that brings you to just about 220 shillings. If you apply the price of 10 units, 220 shillings is all you need to sort of invest in VUCA to start with. Is it convenient? Yes, it is convenient because you're using a digital platform, so you do not have to go to a place or fill paperwork or call your stockbroker or share a lot of information. In terms of rental units, it's not convenient. It takes time to build, it takes time to get occupancy, it takes time to manage and run and collect rent and all that stuff. There's no tax incentives. However, rental units give you a stable income. Once you've gotten occupancy, you have tenants on board, you expect to receive rent every month, okay? For plots of land, there's no development on those plots of land. So the only play is usually capital gain over a long period of time. There's quality of assets, so which eventually, depending on the area of what, you might get some capital gain, but there's no income that comes out of it, okay? If you look at NSE equities, yes, they're affordable, they're convenient, because nowadays there's many ways of buying that. There's some tax incentives. Do they offer stable income? Depending on the performance of a company, and even when it performs, there's no requirement that companies have to pay dividends every year. Sometimes companies decide to retain earnings for various things because they want to get into other markets or they want to expand, but there's quality of assets. For insurance investment products, it's affordable, convenient, there's some tax incentives, but it does not offer you stable income, but it's an investment that you should consider when you're diversifying your portfolio, offers you good quality of assets. Conventional money market funds, a lot of you know you're investing in this. It's affordable, and there's applications nowadays, so you can quickly fund your account via M-Pesa. You can see how you're doing, how much you're holding. You can also withdraw if you want to do that. So there's convenience. Tax incentives, it does not offer tax incentives. I mentioned that if you get a quoted rate, say for 10%, in a money market fund, you have to think about the 15% that will go to taxes. So your effective rate is actually 8.5%. For REITs, I mentioned that the capital gain is not charged taxes, and there's 5% withholding tax on dividends paid. So if you look at how effective, how efficient, tax efficient these investments are, REITs are quite tax efficient, right? Do conventional money market funds offer stable income? Absolutely, because they pay an interest, a daily, some monthly. So there's a consistent income which goes into it, and there's quality of assets, because these companies, these schemes invest in assets which are regulated by Capital Markets Authority. So let's look at some personas. Jennifer, Lucy, and Mark. These are actual people in VUCA. So Jennifer is 26 years old, Lucy is 35 years old, and Mark is 48 years old. So if you look at what these three typical investors look for in an investment, it will be totally different. They're going through different circumstances, the risk appetite is different, and they have different in terms of expectations when you look at dependence. So what do they look for in investment? Obviously, when you're young, you want maximum returns in the long run, okay? And when you're young, the reason why the risk appetite is high is you can afford to make mistakes, okay? And correct them as you grow older. So at this age, you'll see a lot of people also have exposure in, for instance, in certain asset classes which are not regulated, but they offer high returns, and which is fine. At 35, Lucy now has a child, so she's a bit more sensitive in terms of what she's investing in. So she's worried about how quickly can I access my funds, because kids grow quickly, kids get sick, emergencies come in place. So liquidity is a key consideration. When you look at Mark, who's 48, supporting retirement, and therefore safety and security of their investment is what they look at, because they want to look at, they're looking forward to a comfortable retirement. So any investment has to cater to all these personas. Does it offer decent returns over medium term and long term? Is it liquid? And how safe and secure is it? So I posit that for REITs and VUCA, we touch all the three, because one, we offer dividend payouts at least twice a year, and we are regulated. We are listed in the USP, so it's easy for you to access your funds if you wanted to liquidate those funds. So if you look at those three and looking at the incomes which you define there, for Jennifer, who earns just about 70,000, if she did 8% of that into VUCA every month, which means 7,000, and since she's young, decides, okay, I'm going to invest for 20 years. Again, there's no tenor requirement when you're investing in REITs or VUCA. This is just your own personal plans. In 20 years, she would have invested 2.78 million shillings, but the accumulated wealth at the end of that period is 6.61 million, meaning that by the time she's 46, because now she's 26, she would have a capital of 6.61 million shillings, which she can liquidate, or she can decide, I'm going to remain invested and earn a payout of 654,000 shillings every year. So this would give a passive income at that age, so that the work you've been doing in terms of accumulation of wealth then starts paying off at some point. And this, because it's passive income, would be reinvested in other initiatives or cover certain costs if you're, for instance, choosing to retire early. If you look at Lucy, she's 35, earns a bit more, and therefore if she does 8 to 10% of her income, is doing about 21,000, and decides to invest for 15 years. The total amount invested would be just about 5.4 million shillings, but the accumulated wealth at the end of that period would be just about 10.67 million shillings. Again, because then in 15 years, Lucy will be touching 50, she can decide, anyway, I'm retiring, I'm going to liquidate my investment. I have 10.6 million shillings in capital. I can start a different business, or I can remain invested and get a passive income of just about 1,079,000 shillings every year. If you look at Mark, we mentioned what Mark's age is, 48, and therefore Mark has a limited period of time to invest before retirement, so chooses to do just about 35,000 shillings for 10 years. He would have invested 5.28 million shillings, but the wealth accumulated then about 10 years, it's 8.32 million shillings. Again, since Mark is approaching retirement, he can decide, hey, I'm going to liquidate the 8.32 million shillings and start a business, or buy whatever I want to buy, or go on holiday with my wife. Or he can also remain invested and continue earning a passive income of 869,000 shillings year on year. So what people choose to invest in and how much they choose to invest in is really aligned to their goals. And therefore, there's no standard way of investing. But what we normally advise is start small. Start small. And I'd like to give a bit more information around how, if you would be interested in joining or getting into REITs, how you can do that. So the first thing is, if you're interested in joining, you'd have to either be invited to the investment club, because this is an invite-only investment club. So that can happen either through, either digitally by filling this form online. If you look at our website online, so you're able to share some information online and you get an invite from our contact center team. Or you can also get an invite from a member, somebody who's existing, who's already invested in VUCA. You can also share your information, or rather your emails with Muthoni at the end of this webinar if you're interested, and Muthoni can arrange for you to get invited to the club. We normally advise in every investment journey, as you get to learn about an investment, start small. Okay, that's a message. Start small, because then, one, you develop discipline over time, and two, you're able to consistently invest. So we have 6 investment categories, and since it's an investment club, we charge a joining fee and an annual fee. And we normally advise investors to start at silver. This allows you to invest up until 100,000 shillings annually. And the joining fee and annual fee is just about 998 shillings. There's a service charge of 3%, which is charged when somebody is trading at the USP, and that is accumulation of trading charges of our CMA-approved designated broker, administrator, NSE charges, and is only applicable during trading. Now, the beauty of starting small, and I mentioned this, you grow the habit over time, and even as your income grows, or once you're comfortable with the decision of investing, once you've started enjoying your dividends, you've started seeing capital gains, then you can expose a bit more of your capital to this investment. Thank you very much. I'll take any questions at this point, if there are any.
Yes, Donald, there are a couple of questions. So I'll just first of all front the questions that are on the chat session.
Right.
There's a comment from Steven saying, he says, some REITs have experienced problems in the recent past, leading to public outcry. How do you overcome this?
Thank you very much. And I believe that was the first REIT in the market. So like I said, different promoters have different strategies to market. And the most effective one is, by the time you're getting a property in the income REIT, it has occupancy. And once the investors put money in the REIT, you're quickly able to purchase those properties and get them income generating. So if you look at the other REIT, they raised funds in the market, but it took just about 2 years before they could lock in their first property. So like I mentioned, the biggest risk or the biggest driver of income in a REIT is occupancy. Okay, so you have to figure a way of how, by the time you're getting a property in the REIT, it's already stabilized, it has tenants on board, and also the asset class you get into has to be attractive. So how do we overcome this? In the case of Aecon REITs, it was clear that we required a development REIT. And this allowed us to develop our own properties, okay, which are outrightly bought and then developed in the REIT. So by the time you're introducing these properties in the REIT, two things have happened. One is they're fully developed, okay? So you're not going to the market to haggle for properties at market prices and so on and so forth. And two, they're fully occupied. That is very, very important as a strategy. The second bit is the asset class we chose to get into. I mentioned this. If you look at, the other REIT is mostly commercial properties. So what happened after COVID came into place is that companies gave up entire floor spaces because now employees are comfortable with technology and they're able to work from home. We are holding this webinar, virtually. Before, this would be in a conference room or in a fancy hotel with a lot of arrangements in place. You don't require that anymore. And therefore, for that reason, a lot of companies, and I know a lot of you are also running farms, you do not take up entire floors because you don't need those floors. So that has affected commercial property returns over short and medium term. So how we cure that is, for us, we got into purpose-built student accommodation, and I defined why we did that, because the demand is nascent, the demand is huge. The supply of student housing beds is just about 10% of the demand. However, the most, when you look at the most attractive thing is, currently there's 500,000 students, 500,000 kids turning 18 every year. Okay, you can check that from the data of people who are doing KCSE. That number is growing 5% annually. So by 2030, that will be 1.2 million kids turning 18, meaning that there will be even bigger demand for purpose-built student accommodation. So that is how we have sort of overcome that. Right, there's another question I'm seeing. You indicated that income REITs must pay 80% of their income. Confirm the requirement is income and not profit. Yes, the requirement is ordinary taxable income and not profit. That's to Christine. Is there minimum investment requirements? For REITs, yes, and the law there's a minimum investment requirement of 5 million. However, for VUCA, the minimum requirement is just about 10, is just 10 units, and each unit costs 20.8 shillings. So that's just about 208 shillings. Then how can a foreigner invest with REITs? So yes, a foreigner can invest in REITs. All you require is an alien card and the KRA PIN, because the KYC has to be complete. And then in the REITs, then like the way Chama members pool and decide to invest in land or housing, earning real estate income and dividends. Yes, this is the best decision. Thank you, Merima. Yeah, so it's just like a Chama, where Chama members pool money and then decide to invest in land or housing. But in this case, it's a regulated Chama, which by the time you're raising money, there's property that is ready to be invested in, which is income generating. So you're not going to buy land, which waits, and then you build in that period. So by the time you're buying into a REIT, it's already receiving rent and it's income generating. And the reason for that is so that the shareholders start earning dividends early. Then from Maurice Odwar, how do the principles driving REITs differ from those behind unit trusts? So for unit trusts, I mean, most unit trusts are investing in government securities. Those ones slightly differ from real estate, because the factors affecting real estate is what affects REITs, and this is primarily the demand of the asset class. So if you do residential, what areas are you doing residential? To what scale are you doing residential? And what is your rental, pricing point? If you're doing commercial, I already mentioned some of the challenges you might encounter if you're doing commercial, but it's also attractive. There are people doing warehousing. There are people doing there are people who do, oil rigs. It depends on what asset class that you get into and how attractive, how consistently you can get rent into it, right? From Masi Mutai, can the dividends be plowed back into your VUCA account? Also, how does an investor receive dividends? Absolutely. So the dividends are usually paid into your VUCA account, and therefore, after they're paid into your VUCA account, the investor has the option, because that has to be triggered by the investor, to either reinvest the dividends or withdraw the dividend, either to your account or to M-Pesa. Right, Muthoni, unless there are other questions, I think that's what I can see up until now.
Okay, I can't see any other question as well on the chat session, but you're most welcome to unmute yourself and ask your question instead of typing it in the chat session. You can unmute yourself and just ask your questions. Yes, Samsung, it doesn't have a name. Anybody with a question or a comment? I'll put our email address on the chat session in case anybody want to get in touch with Donald, as he has rightfully pointed out earlier on. And then we can start investing in REITs.
Hey, Donald, hi, how are you?
Very well, thank you.
Yeah, great presentation. Just a quick one for me. What are the, what are the, you know, there has to be a cost for the investor. So besides the percentage I saw you indicating there, what other costs are there? Because sometimes you get into this and somewhere along the line, you, for example, want to draw down on your investment and you are told, you know, there's this and that and so on. So my worry with these kinds of investments is that sometimes at the point when the presentation is being made to you, you are not told that there are certain things, there are certain hidden costs and so on. You're just told it's in the paperwork thereafter. So it would be important to know very critically, what are are there any other costs in this?
Right. So fortunately for us as a regulated entity, you cannot put costs in the small print. I don't know if you can see my screen now. Are you able to see my screen?
Yes, I think you can as well, Maurice.
Yes, Maurice, can you see the screen?
I think we've lost him just slightly.
Okay, so there are primarily
I can see it.
Right, yes. So
I'm here, I can see.
Right, so let me just highlight it for you. So there, on the left side, so you'll see there's a joining fee for depending on whatever category. And like I said, if you're starting at a silver, which is the you know, the entry level category, there's a joining fee. This is a one-off fee, and there's an annual fee. So this is paid you know, at every year, you know, every calendar year after you've first invested. So you have the joining fee, the annual fee, and the service charge. Now, the service charge is charged because these securities are traded on the Nairobi Securities Exchange, USP. So unlike your typical money markets where you're withdrawing directly from the fund, this one, every time you make a buy or sell, in fact, the word is buy or sell, you're literally buying if you acquire investing. If you're withdrawing, you're literally selling your units or shares. So these are the only three allowed charges by the regulator, and these are the only charges you will encounter when you're investing in REITs. Is that sufficient?
Okay.
Yeah.
Great. Thank you.
Thank you.
That's good.
Thank you.
All right. Anyone else? I can see a comment from Sheila. Donald, she says, very wonderful presentation. Thank you so much.
Thank you very much.
Comment?
Good friend.
Any final comment? We are actually way past our timeline.
Right.
All right. If there's no further comment, Stephen, there's a question.
Right. Who are the owner? Right. So a REIT is an incorporated entity, so it's owned by investors. However, every REIT has what is called a sponsor, and the sponsor is a company or a group of people who have, you know, invested heavily in that REIT, or who are significantly invested in that REIT. In our case, that is Acorn Holdings Limited, and Acorn Holdings Limited is owned by Helios, who is a venture capital firm. So 50% owned by Helios, who is a venture capital firm. Right.
Okay.
For some presentation with a lot to take in. I think one of the things we'll do, Muthoni, is I'll share the presentation so that for those people who share their emails, you can always share the presentation for them to go through it, yeah, to familiarize themselves with anything they might have missed. So I'll share the presentation with Muthoni, and she will be able to share it with the team or with the audience.
Thank you. We'll do that. We'll do that. Maurice, you have any other final?
Before you close.
Yes.
Yes. Just a final one. I think I'll just stop my video because of the internet.
Right.
Now, my question is, how do you take account of fluctuations in occupancy or in tenancies? You know, it's not always that a building will be occupied, 100% all of the time. So how is that factored into the returns for the investor?
So a building literally breaks even at just about 40%. Okay, so when doing investor projections, we are extremely conservative, and this is because also the operating environment changes with time, because it's a long-term investment, and that's why we're very conservative with that. However, the requirement also that we have in place, and this is from a regulator's point of view, is the stabilization period before you get the property, the income REIT. And that's why I told you, when you're doing a REIT and you just do an income REIT and you go to the market and buy a property and you require 1 year to fill up occupancy, then you'll have a challenge. So one of the things we've done is we have 2 separate REITs. The development REIT develops, okay? And before development is a lot of research which goes into place to figure out, 1, the affordability of that property in the area, where it should be located, what sort of demographics we're looking at, and therefore after development, and you'll see most of our properties are right next to universities, there's a period called the stabilization period. What that simply means is that the property developer will do whatever it is that they need to do legally to ensure that they popularize the brand, they get occupancy to 80%, and that occupancy has to be maintained at that level for at least 6 months to 1 year. Before then, you can get that property into the income REIT. Now, if you look at the bulk of our properties, look at the, for instance, Strathmore, Wilson View, the average occupancy is usually 96%. In some days, it's 100%. Why? Because it's quite attractive. There's not many other, properties in that area. As much as there's competition, for instance, from Parallel 4, we have a superior offering. We've created, we've created communities in terms of students. So it's a really cool factor once you're an alumni of Kwetu. So a lot of students are preferring to go there. One, you have a building which has all the amenities. You have study areas. You have conference rooms. You have a library. You have lounges and places for recreation. You have communities. We have staff. We have student events every month. So where they come together and they either do movies, do game nights. They have competitions amongst themselves. So football leagues, basketball leagues, rugby leagues. All this is meant to create a sort of a community, and therefore create stickiness from a business point of view. And we have seen a lot of that. So if you speak to anyone who's gone to Kwetu, they're quite opinionated about the fact that, they went to Kwetu or they lived in Kwetu, okay? Pretty much the same way we know. Some people will be very proud of the schools they went to. So that is a very important factor in terms of driving occupancy, but not just occupancy for the sake of it, is ensuring stickiness. Now, if you look at the period during COVID, okay, where the government came and said, everything is shut down and everything like that, the queries we got from parents and students were overwhelming. And that's why the properties could not stay closed for more than 3 months. And that's an act of government. What came out clearly is, and if you look at ourselves, those of us who are lucky to have homes where you have your own bedroom, is if you're studying from home, chances are you're studying from your bedroom. And the way university education is, you will require to discuss, you'll require to engage with other students. So if other students come to your home, a parent will not allow, another student to go to your room, and you most likely take over the living room, where your smaller sister or brother is also doing her studies. So it's not a very conducive environment. You'll also be lucky that it's not that Thursday that you're supposed to do some house chores or make chapos for the family. So because of that, we see a lot of demand, and that's why the way we built the brand drives a lot of demand to the brand, and in turn occupancy. So that is very well thought out. And I also mentioned why we got into the asset class we got into, because then we have not struggled with occupancy in that asset class. And it is de-risked, because in every property you have just about 1,000 students. You de-risk that by diversifying occupancy to many students, as opposed to where you just have 4 or 5 companies in one commercial building. I don't know if I've answered your question, Maurice.
Great, perfect.
Thank you.
Thank you so much, Donald. I don't think there's any other question that I can see from the chat session. I think we've gone once, twice, thrice on the question sections. Nobody's coming through. So we want to say a very big thank you to you, Donald, for agreeing to actually come and do this. Somebody has actually asked us, when are you coming back again? So that will be work in progress at some point. But we want to thank each and every one of you participants who has also taken the time to actually join us and be part and parcel of this. So we're going to upload this. We have a YouTube channel, but in case you'd also want more information, I've put the law firm's email address on the chat session, info@njoguassociates.com. And then I think we can communicate on the side of this. Thank you so much, and do have yourselves a great afternoon. Thank you as well, Stephen. Great presentation. We can have more sessions to know the progress. Definitely that will happen. Thank you so much, and have a good afternoon.
Thank you very much.